Welcome back to the Deep Dive. You know we love to get our hands dirty and dig into those financial reports, and today we're tackling two energy giants,
Yeah.
Chevron and ExxonMobil.
Yeah. Always a fun matchup.
This quarter was interesting, to say the least.
For sure.
We want to figure out who really knocked it out of the park, and maybe even more importantly, who's poised for success in the future.
Right. Who's got momentum.
Exactly. And we're going to be using our trusty earnings checklist, along with some wisdom from the one and only Ray Dalio to guide us.
Love it.
Buckle up, because Chevron returned a record amount of cash to shareholders. But is that enough to call them the winner?
Well, it's definitely a strong move. It's interesting to see how these two industry titans are choosing to flex their muscles, you know?
Totally. So first, let's just get those earnings numbers out of the way.
Yeah.
Chevron pulled in $4.5 billion for Q3 2024, which is actually down from the $6.5 billion they earned in the same period last year.
No.
Now, ExxonMobil, they announced a massive $8.6 billion in earnings, the highest in the entire industry. But even for them, it's a dip from the $9.24 billion they raked in just the previous quarter, in Q2 of this year. So what are your initial thoughts on these numbers?
Well, like you always say, it's never just about the absolute numbers. It's about the bigger picture, right?
Right.
We need to look at the trends, the context. Chevron's earnings are down year over year. ExxonMobil's down quarter over quarter. But here's the thing. Both companies returned a hefty chunk of change to their shareholders.
That they did.
Chevron gave back $7.7 billion, and ExxonMobil shelled out a whopping $9.8 billion. They even bumped up their quarterly dividend by 4%. So what jumps out at you when you see these initial figures? Anything surprising?
Honestly, for me, it's kind of mixed bag. On the one hand, those shareholder returns from Chevron, they're pretty eye-popping.
Yeah.
But on the other hand, ExxonMobil's overall earnings, just undeniably strong, makes you wonder what's driving those numbers right. What's the story behind the headline?
Right, exactly. And that's where things get really interesting, because despite Chevron's lower earnings, their production numbers tell a story of growth.
Okay, I like where this is going.
They reported a 7% jump in worldwide oil equivalent production compared to last year.
7%, that's huge.
That is huge. A big chunk of that increase comes from record-breaking production in the Permian Basin.
Okay.
And you can't forget their recent acquisition of PDC Energy.
Right. They've been making some strategic moves.
For sure.
And they didn't stop there. They've also got those big projects in the U.S., Gulf of Mexico, Anchor, Jack St. Malo, and Tahiti, all up and running.
All systems go.
They're definitely playing the long game.
Absolutely. Those Gulf of Mexico projects, those are key to Chevron's long-term strategy. But hold on, because ExxonMobil isn't just sitting on its hands either.
Oh, I'm sure they're not.
They hit their highest liquids production in over 40 years, pumping out an incredible 3.2 million barrels per day.
Wow, that's impressive. What's fueling those numbers? Is it a similar strategy to Chevron's investing in key projects?
You hit the nail on the head. They're both planting seeds today for a harvest of increased production tomorrow. Now, I'm curious, how do these production figures, how do these influence your initial impression of each company's performance? Are you starting to lean one way or the other?
It's tough to say. We're seeing some real signs of growth from both companies, which is always a good sign.
Absolutely.
But let's switch gears for a second and talk about refining and chemicals, because that's where things get a little more complicated.
Yeah, you're right. This is where industry trends can really start to muddy the waters a little bit.
For example, Chevron's downstream earnings actually decreased compared to last year. They said it was because of lower margins on refined product sales.
Yeah, and ExxonMobil facing similar headwinds. They're also seeing those weaker refining margins and those lower natural gas prices definitely haven't helped. It's important to remember that refining, it's super sensitive to these external forces like global supply and demand, even what's happening on the geopolitical stage. It's not always smooth sailing.
That makes total sense. So are they just at the mercy of these market forces, or are they doing anything to counter these challenges?
Oh, they're not just sitting back and accepting those trends, that's for sure. Both companies are making some strategic moves.
Give us the details.
Well, ExxonMobil, for instance, they're focusing on selling higher value products to kind of offset those lower margins. And guess what? It's working. They actually achieved record high-value product sales in their Product Solutions division, up a whopping 10% year over year.
So they're finding ways to ride those waves. Pretty smart.
Yeah, very strategic.
But what about their overall financial health? And how are they returning value to shareholders? Those are the big questions, right?
Those are the million-dollar questions. Let's start with Chevron. They're aiming to cut a massive $2 to $3 billion in structural costs by the end of 2026. And remember, those huge shareholder returns we talked about, well, $4.7 billion of that came from share repurchases just this past quarter.
Okay, so they're tightening their belts and sharing the wealth with investors. What's ExxonMobil doing on that front?
They're all about efficiency, too. They've already chopped a cumulative $11.3 billion in structural costs since 2019 and are gunning for a total of $15 billion in savings by 2027.
Wow.
But here's the kicker. They're planning to buy back over $19 billion in shares in 2024 alone.
Whoa, they are not messing around. Seems like both companies are laser-focused on cutting costs, but ExxonMobil's share repurchase plan is on another level. What does all this tell us about their financial health and their dedication to giving back to shareholders?
Well, this is where those handy checklists come into play. You're interested in seeing how these companies stack up against the criteria in the earnings checklist, right?
Absolutely. It's going to give us a much clearer picture of their financial strength.
Well, the earnings checklist, it highlights some key metrics, things like earnings power return on equity or ROE for short debt to equity ratio, current ratio, profit margins, return on capital employed. That's ROCE, price to earnings ratio, better known as the PE ratio, price to book ratio, or PB ratio, equity growth, dividends, and of course, share buybacks.
Okay, so it's a pretty comprehensive list. How do Chevron and ExxonMobil measure up against these benchmarks?
We'll get into the nitty-gritty in a bit, but just glancing at their financial reports, a few things pop out. Both companies have healthy ROEs and ROCs, which tells us they're using their capital efficiently. That's a good sign.
And their debt-to-equity ratios are relatively low, suggesting they're not drowning in debt.
Exactly. However, we need to dig deeper into their financials to get the complete picture. For instance, Chevron's strong free cash flow, driven by those production increases and cost reductions we talked about, that's a major plus.
And their record shareholder returns definitely show they're committed to rewarding investors. But what about those shrinking downstream earnings? That has to factor into the equation somehow, right?
Absolutely. And then there's ExxonMobil. Their industry-leading earnings are impressive, but we need to understand what's driving those numbers. Is it sustainable growth, or are there some one-off factors at play?
Plus, they're buying back shares like crazy. But we need to figure out if they're doing it at a good price. It wouldn't make sense to buy back shares when the stock is overpriced.
Precisely. So while both companies are showing signs of financial strength, it's not a clear-cut victory for either one just yet. The earnings checklist gives us a framework for evaluation, but we need a thorough analysis of their financials considering those industry trends and future outlooks to really make an informed judgment. Before we dive into the numbers, I'm curious, based on what we've discussed so far, are you leaning towards one company over the other? And what metrics from the earnings checklist stand out to you the most?
That's a great question. I'm finding both companies compelling for different reasons. For me, the key metrics are sustainable earnings growth, strong free cash flow, and a commitment to rewarding shareholders responsibly, in a way that makes sense for the long haul. I'm also intrigued by their approaches to climate change and the energy transition, which maybe we could discuss a little bit later.
That's a really important point. Speaking of different perspectives, let's shift gears for a moment and look at these companies through the lens of Ray Dalio.
Okay, love that idea.
Yeah.
Ray Dalio, the founder of Bridgewater Associates, he's famous for his all-weather portfolio approach, right?
You got it. It's all about diversifying across different asset classes like stocks, bonds, commodities, and cash to kind of be prepared for any economic storm.
Right.
So how do Chevron and ExxonMobil fit into that philosophy?
That's the big question. On the surface, they're both, deeply rooted in the traditional energy sector, which, as we know, is facing some serious challenges.
Right.
But if we look closer, we can see how their strategies either align with or deviate from Dalio's principles. For instance, Chevron's been actively divesting assets, including a recent $6.5 billion sale of Canadian assets. They're aiming to offload $10 to $15 billion worth of assets by 2028.
Interesting. So are they trying to move away from traditional energy?
That's one way to interpret it.
Okay.
They're also investing in lower carbon businesses, which could be seen as a nod to Dalio's emphasis on diversification. But it's not just about asset allocation. It's also about managing risk and thinking long-term, which are core to Dalio's approach.
Absolutely. So how does ExxonMobil stack up in that regard?
Well, they're doubling down on their traditional energy production, which could expose them to more risk in a changing economic environment.
However, we can't forget that they are investing in hydrogen and carbon capture technologies.
You're right. Those initiatives, along with their focus on developing climate solutions within their existing business model, show they're not completely ignoring the changing landscape. But the question remains, are these efforts enough to balance out the risks of being so reliant on traditional energy sources?
That's an excellent question. And it brings us to a crucial topic: climate solutions and the future outlook for these companies.
Exactly. We can't ignore the growing importance of climate considerations in the energy sector. It's not just a nice-to-have anymore. It's a must-have for any company that wants to thrive in the long run.
I couldn't agree more. So let's dive into those climate solutions and see how these companies are preparing for the future. I think you'll find this next part especially interesting. Welcome back. Now it's time to roll up our sleeves and dig into those financials. Let's see how these companies measure up against the earnings checklist, shall we?
Let's do it. I'm ready to crunch some numbers. First up, earnings power. This looks at a company's ability to generate consistent and growing profits, right?
Exactly. And one of the best ways to gauge earnings power is by looking at free cash flow. It's the cash a company has left over after covering its operating expenses and capital expenditures. Think of it as the money they have available to reward shareholders, pay off debt, or reinvest in the business.
So who's got the edge in the free cash flow department?
Well, Chevron's free cash flow for the quarter was $5.6 billion. Now, if we strip out the impact of working capital changes, which can fluctuate from quarter to quarter and sometimes cloud the bigger picture, their free cash flow comes in at $4.2 billion.
Okay, that makes sense. It's like filtering out the noise to see the real signal. So what about ExxonMobil? How does their free cash flow compare?
Hold on to your hat, because they generated a massive $11.3 billion in free cash flow for the quarter. Even after adjusting for those working capital changes, it's still a hefty $8.9 billion.
Wow, that's more than double Chevron's number. Does that mean ExxonMobil is the clear winner in this category?
Not so fast. Free cash flow is an important piece of the puzzle, but it's not the whole picture. We also need to consider their capital expenditure plans, how much they're investing back into the business, and how they're using that free cash flow overall. Are they hoarding it, splurging on risky ventures, returning it to shareholders? It's all about context.
Right. It's like having a big pile of cash doesn't mean much if you don't know how to use it wisely. So what's next on our checklist? What about return on equity, or ROE?
ROE, a classic measure of how efficiently a company is using its shareholders' money to generate profits. The earnings checklist suggests aiming for an ROE of over 15% consistently over time. So let's see how our contenders stack up. Chevron's ROE for the quarter was 10.1%, which is actually lower than their historical average.
Interesting. And what about ExxonMobil's ROE?
We don't have their specific ROE for the quarter, but based on their earnings and equity, it's likely to be healthy. We'd need to delve deeper into their financials to get the precise figure.
Okay, we'll add that to our list of things to investigate. Now let's move on to the debt-to-equity ratio, which gives us a sense of a company's financial leverage.
Right. This tells us how much debt a company is using to finance its assets compared to its equity. The earnings checklist recommends a debt-to-equity ratio of less than 0.5, meaning a company should ideally have no more than 50 cents of debt for every dollar of equity. Too much debt can be risky, especially if the economy takes a downturn.
So how does Chevron and ExxonMobil measure up in terms of debt?
Chevron's debt ratio is currently 14.2%, and their net debt ratio, which factors in their cash and cash equivalents, is even lower at 11.9%.
And ExxonMobil's debt-to-capital ratio is 13%, and their net debt-to-capital ratio is a mere 5%. So they're both pretty conservative when it comes to debt, right?
Absolutely. Both companies are well within the recommended range, which suggests they're managing their debt responsibly. This is a positive sign, especially in today's uncertain economic climate. It gives them more flexibility and resilience to weather any potential storms.
That's reassuring to hear. Now let's talk about liquidity, a company's ability to pay its short-term obligations. How well-equipped are Chevron and ExxonMobil to handle their short-term bills?
That's where the current ratio comes in. It measures a company's ability to cover its short-term liabilities with its short-term assets. A current ratio above 1.5 is generally considered healthy.
Do we have those figures for our two companies?
We don't have the precise current ratios right now, but we can get a good idea by looking at their balance sheets. For instance, ExxonMobil finished the quarter with a whopping $27 billion in cash. That's a sizable safety net.
Wow, that's a lot of cash on hand. So even without the exact current ratio, it seems like they're in a pretty strong position.
Agreed. Now let's move on to profitability. The earnings checklist emphasizes the importance of profit margins, which tell us how much profit a company generates for every dollar of revenue.
Right. It's all about efficiency, squeezing as much profit as possible out of each dollar earned. We know that Chevron mentioned lower margins on their refined product sales, which hurt their downstream earnings. Does that mean their overall profit margins have taken a hit?
It's possible. But to know for sure, we'd need to analyze their full income statements. Remember, there are different types of profit margins to consider gross margin, which looks at profit after deducting the direct cost of goods sold, and operating margin, which factors in other operating expenses like marketing and administrative costs. ExxonMobil also mentioned weaker refining margins, and those lower natural gas prices have likely impacted their profitability as well.
So it seems like external factors are playing a big role in shaping their profit margins, right?
Absolutely. Both companies are operating in a dynamic industry where commodity prices, global demand, and even geopolitical events can significantly impact their bottom line.
Okay, so it's not just about internal efficiency, but also about how they navigate those external pressures. It's like they're sailing a ship in choppy waters. They need to be skilled navigators to stay afloat.
I like that analogy. Now let's talk about return on capital employed, or ROCE. It's similar to ROE, but takes into account both debt and equity financing. A high ROCE shows us that a company is using its capital effectively regardless of its capital structure. The earnings checklist recommends aiming for a ROCE of over 15%.
So how do Chevron and ExxonMobil measure up on this metric?
Chevron's ROCE for the quarter was 10.1%, which, like, their ROE is a bit lower than their historical performance.
And for ExxonMobil, do we have their ROCE figure?
We'll need to dive into their financial statements for the precise number, but considering their robust earnings and efficient capital management, it's probably pretty solid.
Okay, so it sounds like both companies are showing mixed results when it comes to profitability.
That's right. And this highlights why it's so important to look at these metrics over time to spot trends and understand the underlying drivers. A single quarter's performance doesn't always tell the whole story.
Makes sense. So what about valuation? The earnings checklist mentions the price-earnings ratio, PE ratio, and the price-to-book ratio, PB ratio. What can these ratios tell us?
The PE ratio gives us an idea of how much investors are willing to pay for each dollar of a company's earnings. A lower PE ratio can sometimes suggest that a stock is undervalued, meaning it could be a good buying opportunity.
And the PB ratio compares a company's market value to its book value, which represents the value of its assets minus its liabilities. A low PB ratio can also indicate undervaluation.
Exactly. To calculate these ratios, we'll need the current stock prices for both companies. But it's something to keep in mind as we assess their overall investment appeal.
Got it. We'll factor in those valuation metrics once we have the necessary data. What about equity growth? That's another important item on the checklist, right?
Absolutely. Equity growth measures how a company is increasing the value of its shareholders' investments over time. We can track this by looking at the growth in shareholders' equity on their balance sheets.
So for Chevron and ExxonMobil demonstrating healthy equity growth.
That's something we'll need to analyze further. Both companies are actively buying back shares, which can affect equity growth.
Right. Buybacks can reduce the number of outstanding shares, which can boost earnings per share and potentially increase the value of the remaining shares. But it's not always a good thing, is it?
Exactly. It all comes down to the timing and price of those buybacks. Are they buying back shares when the stock is undervalued, creating value for shareholders? Or are they simply inflating earnings per share without actually increasing the company's intrinsic value? We need to scrutinize those buyback programs.
Good point. Now let's move on to the final item on our checklist, dividends and share buybacks. These are two of the main ways companies can return value to their shareholders, right?
That's right. And the earnings checklist suggests looking for companies that pay consistent and ideally growing dividends.
Well, we know that ExxonMobil just announced a 4% increase in its quarterly dividend, marking 42 years in a row of dividend hikes.
That's an impressive track record. It shows a strong commitment to rewarding shareholders consistently. Chevron also paid out a significant dividend this quarter.
So it seems like both companies are taking shareholder returns seriously. But as you said earlier, it's just one piece of the puzzle.
Exactly. Dividends and buybacks are great, but they don't tell the whole story. Sustainable earnings growth, efficient capital allocation, and a rock-solid balance sheet are all essential for creating long-term value.
Absolutely. So as we evaluate these companies, we need to look beyond just shareholder returns and consider the bigger picture, including those climate solutions and future outlooks we talked about earlier.
Couldn't agree more. Remember, investing isn't just about picking the company with the highest earnings or the juiciest dividend. It's about finding companies that are well-positioned for long-term success, and that includes navigating the challenges and opportunities of the energy transition. Now, speaking of the energy transition, are you ready to dive into those climate solutions and see how these companies are preparing for the future? I think you'll find this next part especially interesting.
All right, we're back for the final round of our Chevron versus ExxonMobil showdown.
Time to connect all the dots and leave our listener with some food for thought, right?
You got it. We've scrutinized their earnings, dissected their financials, and explored their climate strategies. So after all that, what's the verdict? Who really took the crown this quarter?
Honestly, it's tough to declare a clear winner. Both companies had their shining moments.
That's true. ExxonMobil definitely boasted those impressive earnings.
Yeah.
But Chevron countered with those record-breaking shareholder returns. It's almost like comparing apples and oranges.
I see what you mean. And let's not forget, both companies are pouring resources into the future of energy. It's a long game, not a short sprint.
That's a great way to put it. It's all about that long-term vision and sustainability, not just a quick win.
Absolutely. But here's a thought-provoking angle I think often gets overlooked. When we talk about the energy transition, the conversation often revolves around those flashy new technologies, like, hydrogen carbon capture.
Yeah, those definitely grab the headlines. So what are we missing?
Well, I think we sometimes forget about the less glamorous but equally important aspects of the energy ecosystem. Think about things like energy efficiency, grid modernization, even consumer behavior.
You're so right. Those foundational elements are crucial, but they don't always get the attention they deserve.
Exactly. And that's something I'd encourage our listeners to consider. When you're evaluating these companies, or any company in the energy sector for that matter, don't just focus on the shiny new toys,
Right.
Look deeper. Consider their investments in energy efficiency, their efforts to really connect with consumers, and their commitment to building a more resilient and sustainable energy ecosystem as a whole.
So it's not just about the technology itself. It's about the entire system and how it all works together.
That's the key. It's about understanding that interconnectedness of the energy world and recognizing that the transition to a cleaner future requires a multifaceted approach. We need all hands on deck.
That's such a great point. Any other parting wisdom you want to share with our listener before we wrap up?
Just this, stay curious. The energy sector is constantly evolving. New technologies are popping up, policies are shifting, consumer demands are changing. The only way to stay ahead of the curve is to never stop learning, exploring, and asking questions.
Couldn't agree more. Well, that brings us to the end of our Chevron versus ExxonMobil deep dive. We've covered a lot of ground, but hopefully we've given you a deeper understanding of these two energy giants, their strategies, and the forces shaping the future of energy.
Remember, this is just the beginning of the conversation. We've equipped you with the tools and insights to continue your own exploration.
So keep digging, keep learning, and keep that curiosity burning. Thanks for joining us on the deep dive.
Until next time.